There are a ton of advantages and disadvantages with each option. So today we just wanted to go through what those advantages and disadvantages are, the differences between both of the options and how maybe you could use both in tandem with each other to execute your investing strategy. So if, for example, one financial institution didn't like either the location or the Dscr on the property, you could always approach another financial institution who might look at it more favorably than another. There are very specific use cases for each individual solution, and you can use them in tandem. So, purchasing a property conventionally with the financial institution and then doing what you need to do, either doing the renovations or getting the NOI where you want it to be, and then planning out your investment strategy long-term to be able to take on the cheaper debt over a long period of time once you're done all the capital renovations to it, is a great strategy to take into consideration, especially when you're relying on cash flow for the majority of your rental portfolio.
What is up, YouTube? Matt McKeever here. Have you guys ever heard of the great white buffalo? Well, it's this concept of this thing that everyone wants or is constantly seeking, and today we're kind of talking about that. CMHC financing on apartment buildings. This is something I hear so many unexperienced investors constantly talking about, but they don't actually understand. It's a little bit more nuanced than you may understand, so we're going to get into it today, and I'm sure there's going to be a lot of comments and questions, so jump in the comment section, let us know what questions you've got on this subject, but let's jump into it with Josh and Ehren.
Awesome, thanks Matt. Like you said, today we're going to be looking at multifamily refinances, Cmhc insured versus an uninsured product. We decided to do this video because we have started to get a lot of investors come to us looking to get into the multifamily residential commercial space. Now the way that they look to structure these loans is typically they have pooled funds for the down payment coming from other investors. Obviously looking to do some sort of BRRRR or joint venture partnership with the idea that throughout the year and a half term, they're going to force appreciate the building, take that equity, pay out their other joint venture partners, and then use the rest of the proceeds to go on and invest into other projects. Now, last year in 2020, May 28th, Cmhc came out and made some changes to the uses of the equity takeout. So they're actually limiting what you can do with those proceeds. Now, two reasons. One, obviously due to COVID, there were some changes made to their to what they wanted to see that equity use for, and also they wanted to keep on the mandates of their kind of their plan behind supporting affordable housing. So we just kind of wanted to go over those changes with you guys so that you're aware when you guys are moving forward with your joint venture partners what the process is coming in from the acquisition to refinance. If you guys do have a joint venture partner and you are looking to pay them out, there's going to be an intermediate step before you might be able to get to that CMHC financing.
Yeah, there are a ton of advantages and disadvantages with each option. So today we just wanted to go through what those advantages and disadvantages are, the differences between both of the options and how maybe you could use both in tandem with each other to execute your investing strategy. Let's start off with loan to value. Ehren?
Yeah, so CMHC insured, because it is insured, we do have the ability to go up a little bit in the loan to value. So CMHC can go up to 85% loan to value on their refinances, which is going to definitely help you out on that refinance. On an uninsured A side, most lenders are looking at 75% top for their refinance on the loan to value. Now,
in regards to rate, so rate is one of the primary reasons somebody would come to us and say, hey guys, I want a CMHC insured mortgage product, because CMHC products are extremely aggressive when it comes to rate. Right now, you're looking at sub 2% rates in the market. As you can tell, if you have a cash flowing property and you're at the final stages of your investment journey, having that takeout financing for really low rate for a long term is going to allow you to have that sustained cash flow over a period of time. Uninsured mortgage rates currently are around between 2.5% to like 5%, really depending on the type of institutional financing you're looking for. You got everything from a monoline lender, a big five bank lender, all the way to private credit unions and everything in between. So there's a handful of options available to you on the uninsured side. The rates aren't as aggressive due to the additional risk that these lenders are taking because there is no mortgage default insurance on the money, but it also allows you to use the funds a little bit differently than what CMHC would allow you to get into, which is we're going to get into later on in the video.
Next thing we want to touch on is just the term of the mortgage. There is not much variance between the terms between the CMHC insured and an uninsured. CMHC does have the ability to go 10 plus years on their term. Now that's, you know, on special occasions and as approved by CMHC, but other than that, you know, you're still looking at the pretty standard terms between a 1 to a 10-year term for both lenders or for both products. Dscr, debt service coverage ratio. This is something that does vary a little bit going between the CMHC insured and an uninsured lender. So just starting at the CMHC DSCR, so there's two unit counts that we're going to take a look at under the residential space. So if you have a residential building, 5 or 6 units, they are looking at a 1.2 DSCR on the refinance. Now, if that building is 7 units and greater, there's 2 different breakdowns in the DSCR depending on the term. If it is a term over 10 years, they're looking for a DSCR of 1.2. And if the term is less than 10 years, they're looking for a 1.3 debt service coverage ratio. Now, if it's non-residential space, and there's some commercial opponents to that, for a 5+ unit building with a term of greater, like 10 plus years, you're looking at 1.4% DSCR, and if it is a term less than 10 years, you're looking at a 1.5% DSCR. Now on the uninsured side, which can still be just a standard A lender, the DSCR is a little bit different. It does depend and can be specific to each financial institution. Typically, if you're looking at an A lender, so A monoline, a Big 6 bank, or a credit union, they're pretty much looking at a 1.2 to 1.25. Now on the uninsured side, you do have the ability to go to some alternative B type lenders, and those lenders are able to work with DSCRs usually around 1.1 to 1 depending on the product. Now those B lenders do come with a higher rate, so they will be closer to the 5%, but again, depending on the performance of the building, is still an option to refinance out of.
CMHC Advantages. So there's a ton of advantages for taking CMHC financing. It is a little bit difficult to acquire, but if you can, I highly recommend doing it. The low interest rates allow you to have greater cash flow on your multifamily assets. It can be great in regards to takeout financing or a longer term loan. Another advantage of CMHC financing is limited recourse when the loan does not exceed 65% of the lending value. So as CMHC kind of outlines, recourse is limited to the property and not the personal assets of the borrower itself, which can be really attractive if you are portfolio purchasing and you have a handful of different large assets and you're worried about your personal liability. Now, some disadvantages are security. The benefits come with the price. So CMHC Premium on these types of loans start between like 2.5% all the way up to 4.5%. So you are taking on a mortgage default insurance cost. That is a cost that isn't necessarily realized right away because it's built into the equity, but it is an overall cost and diminishes your equity position in the time of purchasing or refinancing. So something to take into consideration is, for the longevity of how long you're going to have that loan for, does it make sense for you to give up that 4.5% equity position just to get a better rate over the long term?
Something else to consider too when you're applying for CMHC financing is the application fee. So there is an upfront application fee. It's about $150 a door. So, you know, depending on the size of the building and how many units there are, could be a sizable fee. Continuing next onto that is a minimum net worth. So the borrower must have a minimum net worth equal to 25% of the loan, and a minimum being $100,000. So that's something that you're going to have to keep in mind as well too. We will obviously assess a personal net worth statement before time, making sure that that net worth is there and supporting. The other thing to know about CMHC too is there are preferred partners and select partners that they do have to work with. Not every lender can be refinanced out of. It does have to be done with a specific partner. So again, making sure you use a mortgage agent that knows which partners are able to work with CMHC.
So another disadvantage of CMHC is there's no alternatives really in the space. So if you don't qualify or your building doesn't qualify for the financing, then unfortunately you don't really have any alternatives that are as aggressive as CMHC currently. Most important thing is that your refinance proceeds cannot be distributed to equity holders, meaning you can't use your refinance funds to pay out partners. It's really important, and it's one of the major changes that CMHC did in this legislation change on the 28th. So many of you, some of your strategies is to refinance to pay out some of your lenders who have given you the capital to be able to purchase the property or do the renovations. CMHC will not allow you to do that.
And it's not just restricted to payout. This is just free equity distribution as well too. So even if you're not trying to pay out a partner and take them off the title, just free equity takeout is limited overall as well. So some of the advantages of going with an uninsured loan, either on the A side or on the B side. Less restrictive equity takeout. So you aren't limited to, being able to take out that equity and paying out partners. So if you are looking to do a burst strategy and one of the key pieces is a payout of a partner or taking that equity out for some other purpose, you are going to have to look at going with some sort of uninsured lender. So whether that is a B lender or whether that is a credit union or a monoline or a big bank type lender, those lenders are going to allow you to take that equity and distribute that to the shareholders. There are faster turnaround times as well too with the traditional uninsured lending. The Cmhc process can take quite a bit sometimes. I think last year in 2020, the average time that we were kind of hearing and seeing was about 3 to 6 months. Could be greater, could be less depending on the application, but it does have a bit of a longer turnaround time on the CMHC side versus just going to a conventional lender uninsured.
Yeah, another advantage of an uninsured refi or purchase on commercial property is going to be your Dscr flexibility. As many of you know, there are a handful of different institutional lenders that we can approach when you have a deal. So we have our big 5 institutional lenders who have specific parameters that they need to hit to be able to fund your loan. And then we have private credit unions and other alternative lenders in the space who maybe have a little bit more flexibility when it comes to certain types of properties. There are a handful of different financial institutions that specify in different types of multifamily or commercial lending, and each individual one is going to have more competitive rates or more flexible terms depending on which one you choose to use. Last but not least, there are more financial institutions to choose from to review your mortgage request. So if, for example, one financial institution didn't like either the location or the Dscr on the property, you could always approach another financial institution who might look at it more favorably than another.
Yeah, exactly. And then looking at the disadvantages of going with an uninsured mortgage. First, you're obviously going to have the higher rate. It's not insured. There is no default insurance on there, so the rate is going to be a little bit higher due to the risk associated. Now, rates are pretty competitive these days, so it's not a total disadvantage if you're looking at a rate between 2.5 to 3.5, but it is higher than what you're going to get on the insured side. The next disadvantage is obviously just a lower loan to value. So you are limited to a 75% loan to value versus the ability to go to an 85% loan to value with CMHC. So that could cut into your equity takeout at the end, depending on what you were going to use that for. And then the last kind of disadvantage is your, because the rate is going to be a little bit higher, that does mean your month-to-month mortgage payment is going to be a bit higher. So that does eat into your total net operating income a little bit as well too. So you will have a smaller deficit coming out of that, out of your monthly cash flow.
Yeah, we also decided to add a handful of the top CMHC questions that we wanted to answer for you guys throughout the end of this video as well. So one of the questions that we usually get is what constitutes permitted use of funds? So when you do your refi, what can you use your money for? And CMHC has outlined specifically what we can use the funds for. One being you can use it to discharge outstanding balance of a current mortgage you have. So if you're refinancing, makes sense, you should be able to pay out the current mortgage you have. Number two is to secure permanent financing on a subject property. So if you're purchasing a property, take that money out and you can purchase another property. They will require that you have a purchase agreement in place just to verify that you are using the funds specifically for that reason. To undertake capital repairs on a current property you have or the current property you're taking the equity out, you are going to need to pull those funds out and use it to do the renovation. You can't back end it, so you can't do the renovations and then say, look, I need the CMHC financing to fund those. It's got to be preemptive to doing the renovations. The second is going to be to purchase other rental properties above 2 units. So one of the CMHC's mandates is to encourage more multifamily housing or more affordable housing. And how they're going to do that is they're going to allow you to pull cash out to buy more multifamily properties. Again, the financial institution that you're going to be doing the refinance with, they are going to require that you have purchase agreements in place to verify where the funds are going from your refinance. And last but not least is to construct new rentals as well. If, for example, you were a builder and you had some equity in other properties and you wanted to use those CMHC funds from your refinance, you could use them to build a multifamily property. Yeah,
exactly. The last question that we have that we see around the CMHC financing is there a prescribed time frame post-funding that you can use those funds for and have those funds permitted to be used for? So the short answer is no, there isn't a specific timeline that you have to be able to use those funds within, but CMHC does rely on the approved lender to monitor, ensure that the funds are being applied to that specific purpose, and it is on that lender to verify. So at the time of underwriting with your approved lender, they're probably going to ask you for a handful of things. Some of those things are probably going to be a construction budget or an expense budget, just the costs that are going to be associated with the the construction or the renovations of the building. If you have a repair and or a maintenance plan, what is the plan to the building? What are you looking to do? And again, what is the cost going to be associated with that? And then subsequent to funding, just any invoices and or receipts that you may have. Again, just relaying the cost across to the lender, so allowing the lender to do their job to verify all the proceeds that are being taken from the product.
As you can see, there are a handful of limitations when it comes to using CMHC financing compared to uninsured financing. There are very specific use cases for each individual solution, and you can use them in tandem. So, purchasing a property conventionally with the financial institution and then doing what you need to do, either doing the renovations or getting the NOI where you want it to be, and then planning out your investment strategy long-term to be able to take on the cheaper debt over a long period of time once you're done all the capital renovations to it, is a great strategy to take into consideration, especially when you're relying on cash flow for the majority of your rental portfolio. So all these things you should take into consideration when thinking about which option to use. And if you don't know, feel free to reach out to Ehren and myself. We'd be happy to run the numbers, let you know, which option is best for you, and to start that process.
Yep, guys, this basically is just helping you guys build your plan down the road. We know the first immediate thought when someone comes to a large commercial multi-type res is CMHC type financing. Again, just being wary of what the limitations are and what your restrictions are, and just making sure that what is that next step going to be? Because if you go into this thinking CMHC and equity takeout to pay out shareholders, it's going to be a bit of a surprise when that plan has to be changed at the last minute. So again, just being able to plan for the future, make sure you have the correct idea as to the subsequent series of events, and just how you're going to be able to use that capital moving forward.
And in case Matt didn't say, hit that like button, smash the subscribe button. We're looking forward to making more videos with you guys.
Thanks, guys.
Thanks again to Josh and Ehren for taking the time to shoot this video. You guys got questions, jump in the comment section, hit them up with your questions. Otherwise, if you enjoyed this video, smash that like button, hit the subscribe button if you're new to my channel, because less than half of you are actually subscribed to my channel. I'll see you guys in the next video.